When we think about corporate strategy, our brains usually go straight to one thing: growth, right? Getting bigger, buying other companies, expanding everywhere. But what if I told you that for some of the biggest, most successful companies out there, the smartest play isn't to get bigger, but to actually get smaller? Today, we're diving into this super powerful, totally counterintuitive idea of growing by shrinking. It's the question every CEO is trying to answer, isn't it? And the default assumption is that strength comes from size. More stuff, more people, more revenue. We see headlines about huge mergers and acquisitions all the time. But you know what? That's really only half the story.
Okay, so check this out. Down below, you've got the chart we all know and love: mergers and acquisitions, companies buying other companies. But the real surprise is the chart right above it. That line, my friends, represents divestitures, companies selling off parts of themselves. And would you look at that volume? It's right up there with M&A. This isn't some rare last-ditch effort. It's a core part of the modern corporate playbook.
So, if companies are doing this all the time, what does divest even mean? It's not always just a simple sale. There are actually a few different ways a company can strategically decide to shrink.
It usually boils down to three main flavors. First, you have spin-offs, where they basically create a brand new, totally independent company from a piece of the old one. Then there are carve-outs, which is kind of like a partial sale, where they sell some shares to the public in an IPO, but the parent company still holds on to a piece. And of course, there are simple asset sales, which is, exactly what it sounds like: selling off a factory, a brand, you name it.
All right, this all leads to the billion-dollar question. Literally, how does a CEO or a board look at their company and decide if breaking off a piece is the right move? Well, it's not a gut feeling. It's all driven by a pretty rigorous financial formula. At its core, the math is actually pretty intuitive. The value you create from the steal is just the price you get for the part you sold, minus the value you're losing by not owning it anymore, and minus all the costs of actually splitting the two apart. The idea is simple, but making that math work in your favor, that's where things get tricky.
So let's zoom in on that. The value you're giving up isn't just one thing. It includes the standalone value of that business, plus any lost synergies, things like shared technology or marketing teams. Then you got the direct disentanglement costs. But the one that really trips companies up, the hidden trap, is that last one: stranded costs.
So what in the world are stranded costs? Think about it this way. Imagine you've got a roommate and you split the bill for your super fast internet. It's a great deal for both of you. But then your roommate moves out. The internet bill doesn't change, but now you're stuck paying for the whole thing yourself. Ouch. That extra cash you're now on the hook for, that's a stranded cost. It's the corporate HQ's budget for things like IT or HR that was once spread across the whole company, but now the parent is left holding the entire bag. But here's the magic. When a company gets this formula right, the payoff can be huge. For instance, a company could sell off a division and use that cash to buy back its own stock. And the result? A potential 4.5% pop in its share price. That's not just a number. That's the market screaming, "Yes, we love this move. You just got stronger by getting smaller."
Okay, so one example is great, but does this hold up across the board? What does Wall Street really think about these big corporate breakups? Let's see what decades of data have to say.
This is the ultimate test, right? After all the complicated math, the negotiations, the restructuring, after all that financial surgery, does it actually pay off for the people who matter most, the shareholders?
Well, the data is pretty clear. The answer is a resounding yes. This chart shows what happens to the stock price, the abnormal return, right after a company announces a divestiture. For spin-offs, the stock gets a 3.3% bump on average. For carve-outs, it's a plus 1.8%. Even for simple asset sales, it's a positive 1.2%. The message from investors is crystal clear. They love focus and they reward these moves.
All right, so we've established that value gets created. That's great. But who gets the bigger piece of the pie? Does the parent company that did all the selling cash in, or does the new, scrappy, independent company come out on top? And wow, the numbers here are just staggering. Seriously, look at this. Over 2 years, those newly independent companies, the subsidiaries, delivered an average return to their shareholders of over 13%. And their old parent companies? A measly 3%. It's not even a competition. The real winner in the breakup is almost always the one that gets set free.
And that just says it all, doesn't it? By selling off a piece of itself, a company creates a new, independent business that is suddenly free to take off like a rocket, often leaving its old parent in the dust. But why? What's the secret?
The secret sauce is right here on this chart. See, it's not just about becoming independent. It's about what that independence lets you do. When the breakup allows the new company to become more focused on what it does best, its returns are a super healthy 8.6%. But for the new companies that don't find that focus, their returns are actually negative. Focus. That is the absolute magic ingredient.
So from now on, when you see a headline about some giant corporation selling off a business you've known for years, don't just assume it's a sign of failure. Now you know to look at it for what it really is, a brilliant strategic move to unlock value by creating two sharper, stronger, and more focused companies out of one.
And all of this leaves us with one really juicy question to think about. When you look at the massive conglomerates out there today, juggling dozens of completely unrelated businesses, you just have to wonder, if growing by shrinking is this powerful, who's going to be next?